Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at energy fuels.
If you find our talks useful, please consider subscribe, like, and comment underneath. So imagine a company whose stock is currently in a 59% free fall, right? Just inciting absolute market panic.
Oh, totally. A complete bloodbath on the chart.
Right. But behind closed doors, they're sitting on nearly $1 billion in cash, and they're quietly building this North American monopoly on the highly specialized materials that power our fighter jets, wind turbines, and EVs.
Yeah, it's a wild setup.
It really is. I mean, we are looking at a company trading around $11.44 right now. That is down massively from its peak back in, January 2026. Usually when you see a drop like that, it signals a structural collapse. But the twist here is that Energy Fuels is in the middle of executing a completely unprecedented pivot.
A total operational transformation, really. They are moving from being a pure-play uranium miner to attempting to become a Western rare earth monopoly.
Which is just a massive shift.
It is. It's such a fascinating disconnect because, the current price action is screaming fear, but their balance sheet is screaming fortress.
Yeah, exactly. And before we get into the actual mechanics of how they plan to pull off that monopoly, we want to mention a resource that might help you analyze complex market situations exactly like this one.
Right. Before we break down today's analysis, here is a remarkably useful research platform for long-term investors. You can explore StockOracle through the special 14-day trial link below in the description.
Yeah, it's a great tool.
It really is. StockOracle is an AI-aided stock research platform for organizing fundamentals, valuation estimates, and AI moat analysis. When you're looking at a company undergoing a massive transition, having all that company data and valuation modeling in one centralized place is incredibly valuable.
Just to be absolutely clear, though, it is a research tool. It is not financial advice. It's not a trading signal or real-time market data. AI insights and valuation estimates can be incomplete or just, plain wrong. You always have to verify the facts yourself and make your own decisions.
Precisely. And you should know that the link in the description is an affiliate link. That means we may earn a commission if you use it at absolutely no extra cost to you.
All right, let's move into the wealth building context. Because when you see a stock down 59% from its highs, the immediate temptation for a lot of people is to treat it like, well, a quick rebound play.
Right, like trying to catch a falling knife.
Exactly, a fast swing trade. But when you actually look at the mechanics of transitioning from uranium mining to a fully integrated rare earth supply chain, you realize this is a massive physical infrastructure story.
Yes, and that dictates your timeline. You have to frame this with a multi-year horizon. We are looking at an 18 to 36-month timeline here. This is a catalyst-driven growth thesis.
So not a quick flip.
Not at all. You are essentially buying into a company that is building national security infrastructure from the ground up. I mean, the geopolitical context here is huge.
Right.
Currently, North America is overwhelmingly dependent on foreign supply chains for the permanent magnets needed for, electric vehicles, robotics, advanced defense systems. Energy Fuels is stepping in to fundamentally rewire that supply chain.
But that takes time.
Exactly. Moving dirt, building heavy rare earth separation circuits, integrating international acquisitions. None of that happens overnight.
I hear that, but let me push back a little here on the psychology of holding this stock. Like, what kind of investor really has the stomach for a 2 to 3 year speculative transition phase?
That is the million-dollar question.
Because let's be totally honest with you, this is not a risk-free parking spot for your cash. While management talks about this grand multi-year vision, you are holding a stock that is going to be incredibly sensitive to, every single construction delay, every regulatory hiccup, and every shift in the macro environment.
Oh, absolutely.
If you are an investor who needs income or stability, watching a multi-year infrastructure build-out is going to give you terrible heartburn.
It absolutely will give you heartburn, which is why it's critical to identify what game you are actually playing. This is for the patient, thesis-driven investor who understands that the real value unlocks only when the infrastructure is actually built and commissioned.
Right.
If you're looking for a quick flip, the inherent volatility of a major industrial transition phase will likely shake you out of your position the moment there's a negative headline.
So we understand the massive multi-year vision they're selling, but grand visions don't keep the lights on, cash does. All right, let's look at the fundamentals to see if they can actually survive the wait.
Let's do it.
Because the fundamentals right now show a company with a very severe split personality. On one hand, you have the top-line momentum. Their trailing 12-month revenue growth is an impressive 21.95% year-over-year.
Which is solid.
Yeah, they're aggressively ramping up their processing of monazite and increasing their rare earth oxide sales.
And we should probably clarify what monazite actually is because it's central to their advantage.
Yeah, please do.
Monazite is essentially a mineral sand packed with these incredibly valuable rare earth elements. But it is also highly radioactive because it contains naturally occurring uranium and thorium.
Oh, wow.
Yeah, that radioactivity makes processing monazite incredibly complex and heavily regulated. Most companies simply aren't legally allowed to touch the stuff.
But then you look at the bottom line, and it is a harsh reality check. Despite that 22% revenue growth, we are talking about a net margin of negative 82.7%.
Ouch.
Right, and a negative earnings per share of 30 cents. That is some serious heavy cash burn happening right now.
It is, but we have to explain how and why they are burning that cash. It is heavy expansion capital expenditure. They're trying to build out a fully integrated mine-to-magnet platform.
Okay, so this is where that $1 billion in cash we mentioned comes in.
Exactly. As of March 2026, they had $0.96 billion in working capital. They're currently executing a $104 million heavy rare earth expansion, focusing on highly critical elements like terbium and dysprosium.
Right, the stuff you really need for high-end magnets.
Yeah. Exactly. And because of their massive cash pile, this expansion is essentially self-funded alongside U.S. government backing. They aren't going to the market and diluting shareholders to build this out.
That is a crucial point for anyone analyzing the resource sector. In the critical mineral space, share dilution is usually the silent killer of investor returns.
It really is.
Companies constantly have to issue more shares to pay for the bulldozers, the concrete, the permits, which just destroys the value of the shares you already hold. Having almost $1 billion in working capital means they can weather their own expansion without punishing their current investors.
And when you look at what that expansion is projected to yield, the future value metrics are just staggering.
Walk us through those numbers.
Let's look at their January 2026 Bankable Feasibility Study, or BFS. For context, a BFS is the gold standard blueprint a company takes to a bank to definitively prove the economics of a project actually work.
Right.
According to their BFS, their Phase 2 circuit alone carries a $1.9 billion net present value. Yeah, and if you combine that with their Varamata project, the combined NPV jumps to $3.7 billion.
That's huge.
They are projecting an EBITDA, which is their earnings before interest, taxes, depreciation, and amortization of roughly $765 million per year.
Let's contextualize that math for a second to see why it's so wild. They are projecting $765 million in future annual earnings power, and the entire company's current market cap is only $2.85 billion.
The disconnect is massive.
It's huge. But to protect those future earnings and actually realize those massive margins, you need an impenetrable moat. And their moat is fascinating because it's entirely regulatory.
It really is. It centers entirely around the White Mesa Mill in Utah. Because of the radioactive nature of monazite we talked about earlier, White Mesa is the only fully licensed and operating conventional rare earth processing mill in the United States capable of handling it.
So if I'm understanding this regulatory moat correctly, having the only licensed mill is basically like owning the only toll booth on a newly built government-backed superhighway.
That's a great way to look at it.
Anyone who wants to travel from raw radioactive dirt to finished clean magnet in North America essentially has to pay your toll.
It's a toll booth, sure, but let's add some nuance. Right now, it's a toll booth that costs $104 million in capital expenditures to maintain, and they are essentially sitting there waiting for the highway to actually finish being built and for the cars to show up. But the reason it's so valuable is that getting a new toll booth approved in this sector takes 7 to 10 years.
Wait, really? A decade?
Yeah, that is the standard environmental permitting timeline for a greenfield rare earth facility in the U.S. Energy Fuels has already cleared that decade-long barrier to entry.
That's a massive head start.
Furthermore, they are diversifying their feedstock. They're bringing in raw materials from Australia, Madagascar, Brazil, so they aren't reliant on a single mine. The ultimate goal is to supply 100% of U.S. heavy rare earth requirements by 2030.
I love the ambition, but here's my skepticism creeping back in. A toll booth is great, but if you are paying a massive construction crew every single day to expand it, your pockets empty out pretty fast.
That's true.
If they're operating at an 82% negative margin right now, isn't that $765 million future EBITDA just a spreadsheet dream? I mean, spreadsheets don't have to deal with supply chain shocks or geopolitical trade wars.
That brings us to the catalyst timeline. Because you're right, we need to know exactly what events over the next few months will turn those spreadsheet dreams into concrete, cash-flowing reality.
Right. What are the specific milestones we should be watching?
First up is the Q3 2026 Final Investment Decision, or FID, on the Donald Project in Australia.
Okay.
And FID is basically the point of no return where the massive checks are actually signed and committed. This is crucial because a positive FID locks in their primary monazite feedstock. It definitively proves they have the raw material to feed that Utah mill for years to come.
Right. You can't run the toll booth if no cars are allowed on the road. Locking in the Donald Project ensures the physical supply chain actually exists.
Exactly. Then you have Q2 2026 earnings, which will give us a granular update on production volumes and capital expenditure progress. But the real structural game changers are expected in the second half of 2026.
What's happening then?
We are looking at the expected closings of two major acquisitions, Australian Strategic Materials, or ASM, and Vacuum Schmelz, or VAC.
And those acquisitions are what actually complete the mine-to-magnet vision, right?
Yeah.
We need to explain how this actually works, because turning dirt into a magnet is a notoriously brutal three-step nightmare.
It really is. Step one is just digging the monazite out of the ground. Step two is separating the elements. And separating heavy rare earths isn't like panning for gold where you just wash away the dirt.
Right.
The elements are chemically bound together at a molecular level. It's literally like taking a fully baked chocolate cake and trying to chemically extract the original flour, sugar, and raw eggs out of it without ruining them.
That sounds impossible.
It's incredibly difficult, and that's the complex solvent extraction happening at the Utah mill.
And then comes step 3, which is taking those separated unbaked powders, turning them into metal alloys, and actually manufacturing a permanent magnet.
Yes.
And that is exactly why they are acquiring ASM and VAC. It literally buys them the factories and the expertise that do step 3.
Precisely. And alongside those closings, we are expecting the finalization of their U.S. government loan. When you stack these specific catalysts together, the feedstock lock-in, the downstream acquisitions, and the government financing it completely transforms the narrative.
Right, they pivot.
Yes. They stop being a speculative developer and start being an executing national champion. The risk profile completely changes once those deals close.
Now let's pivot to the chart, because we need to see how the market is currently pricing all this potential. Looking at the price structure, Energy Fuels is sitting at $11.44. The stock is down over 40% in just a 13-week drawdown.
That is an incredibly violent correction. But when you zoom out and look at the broader context, it looks like a classic post-euphoria mean reversion. Well, they hit a massive high in January 2026 when the feasibility study dropped and those acquisition rumors were flying. And then, the reality of the multi-year waiting game set in.
Right. The market gets excited by the announcement, but gets bored by the actual construction. But what are the technical indicators telling us right now?
What's critical from a technical perspective is that despite that 40% drop, the stock has established a higher low. It is staying well above its August 2025 low of $8.16, which shows underlying structural support.
Okay, that's a good sign.
Furthermore, we were seeing low volume consolidation right now. The trading volume is only about 0.65 times the 3-month average.
So lower volume on a consolidation like this suggests that the aggressive sellers are exhausted. Everyone who wanted to panic sell has already left the building.
Exactly.
But you still have to deal with the extreme volatility here. We're looking at a beta of 1.58. For you listening, this means if the overall market sneezes, Energy Fuels catches a violent cold. If the market drops 1%, this stock is swinging almost 1.6%.
It's a bumpy ride.
It is. And that kind of whiplash is exactly why long-term investors benefit from organizing their research workflows carefully. When the screen is flashing red and the stock is swinging wildly, you need to rely on your fundamental thesis, which is where having a tool like StockOracle to keep your data structured can help you maintain perspective instead of panic selling.
So what does market sentiment look like? If the technicals show a stock catching its breath after a severe beating, how do the insiders and the broader market actually feel about it?
The macro narrative is actually moderately bullish right now. You have news constantly highlighting a severe U.S. supply-demand gap in rare earths, coupled with very supportive critical minerals policies coming out of Washington.
Right, the geopolitical tailwinds.
Exactly. The market recognizes the geopolitical necessity of what Energy Fuels is building. But the ultimate signal, I think you really want to pay attention to when a stock is down this much, is the insider buying.
I love looking at insider activity because it cuts through all the noise. What are the specific numbers?
According to the Squeeze Watch data, the insider MSPR, the management share purchase ratio, is at a perfect 100.
Wow.
That is maximum bullishness. Over the last 90 days, insiders have bought 95,730 shares, and there have been 0 sells.
0 sells. That is incredibly rare.
Right.
Think about the psychology happening there. You have a stock that has drawn down 40%. The company is sitting on nearly $1 billion in cash. And the executives who know exactly what the internal spreadsheets look like, who know exactly how the construction is going, and who know the details of these acquisitions are using their own personal money to buy up nearly 100,000 shares.
It's a huge vote of confidence.
It signals absolute, undeniable conviction in the near-term trajectory. They aren't hoarding their cash, they are aggressively buying their own dip.
That is a very strong signal, but let me offer some pushback here. Is it possible that positive insider sentiment just isn't enough to fight a macro headwind right now?
That's a fair question.
I mean, the broader market seems to be ignoring energy fuels, potentially because of the sector-wide uranium correction we've seen recently. If the whole nuclear and uranium sector is dragging, positive insider buying doesn't guarantee immediate market attention. Management could be entirely right about the company's value, but entirely wrong about the market's timing.
Now let's talk about the risks, because you're hitting on the core vulnerability here, and we need to clearly explain the downside. Beyond just macro timing, the single biggest fundamental risk is execution risk.
Right, because they aren't just building a house, they're trying to build 3 massive skyscrapers at the exact same time.
Exactly. They are actively juggling the $104 million expansion, the massive $410 million Phase 2 build-out targeting 2029, and trying to seamlessly integrate 2 major international acquisitions in ASM and VSC.
That is a lot to handle.
It is. Any regulatory delay, any construction bottleneck in Utah, or any cultural friction in integrating those acquired companies pushes that projected profitability further out into the future. And we know how unforgiving the market is when a company misses a project deadline.
But what about the geopolitical risk? They are trying to compete directly with China in a market that China currently dominates with an iron fist.
That is the Chinese competition risk, and it is the elephant in the room. The bullish thesis assumes energy fuels will have first quartile, highly competitive operating costs once they scale.
Right.
But that math breaks down entirely if Chinese producers decide to aggressively cut their rare earth oxide prices.
They've run this exact playbook before.
Oh, absolutely.
They flood the global market with incredibly cheap supply, effectively starving Western competitors of margins before those Western companies can even reach commercial scale. If you are operating at a negative 82.7% margin right now and a Chinese price war breaks out tomorrow, that billion-dollar cash pile could burn exponentially faster than anticipated.
It's the ultimate stress test. China actively uses price as a geopolitical weapon to defend its market share. If they drop prices through the floor, just as Energy Fuels is trying to bring Phase 2 online, it could severely damage those massive EBITDA projections we talked about earlier.
So with everything on the table, what's the final verdict?
We are looking at a bullish score of 8 out of 10. You should frame this strictly as a speculative bullish opportunity.
Okay.
The reason it scores so highly is the incredibly favorable risk-to-reward ratio. You are looking at a stock trading at a 59% discount from its highs, but backed by a massive $3.7 billion NPV pipeline and a genuine fortress balance sheet with nearly $1 billion in cash.
But we have to reiterate the timeline for you. This requires an 18 to 36-month horizon for patient investors. It is driven by the structural global demand for rare earths and that impenetrable regulatory moat in Utah. But it is heavily threatened by operational execution risks and the looming potential for overseas price wars.
Exactly.
This is absolutely not for short-term swing traders looking for a quick pop.
And we must strictly remind you, we are not telling you to buy, sell, or hold this stock. This is purely an objective analysis of the company's current positioning, risks, and structural environment. None of this is financial advice.
And if you want to organize your long-term stock research in one place, check out StockOracle through the special 14-day trial link below in the description. It combines fundamentals, valuation estimates, AI bull and bear insights, moat analysis, comparisons, watch lists, and portfolio tools.
It's really comprehensive.
It is, but remember, it is a research platform, not financial advice or recommendation to buy or sell. AI insights and valuation estimates may be wrong, so always verify important information and make your own decisions. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this analysis helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua session.
Before you go, we want to leave you with one final thought to ponder as you look into the critical mineral space.
We've talked a lot today about the U.S. government offering financial loans to help build this infrastructure. But what if the government transitions from just offering financial support to mandating by law that domestic defense contractors can only source their heavy rare earths from Western mills? If that structural legislative shift happens, how would that permanently alter Energy Fuel's pricing power against Chinese price war? Think about it.